In this session, we will be starting off with our discussion on accounting process once again, and we will be discussing in detail each of these steps. We saw that accounting process is a systematic process of recording, classifying, and summarizing transactions in a business. When we discussed the definition of accounts earlier, we saw that accounts is the art and the science of recording, classifying, summarizing. When we learned accounting process, we are coming across these three steps once again. We are talking about the systematic process of recording, classifying, and summarizing transactions. So, what exactly is accounting process? So, accounting process is a sequence of a series of events. It's a series of processes that you are expected to carry out in an organization. Now, why are you expected to carry out these steps in the organization? Because if you want the overall full-fledged benefit of accounting as an activity, you should be able to leverage on the three steps: recording, classifying, and then summarizing transactions. Okay? So recording, classifying, and then summarizing transactions in the business. Moving forward, let's talk about how exactly does the accounting process takes place. Accounting process all starts with transaction. We saw that transaction is the economic activity which results in the exchange of goods or services in return for money or money's worth. For a transaction to be completed, we saw that there is the necessity of two categories of people to interact. You have buyers on one side, you have sellers on the other side. So the buyer and the seller would come together, they would interact. As a result of the activity which unfolds because of their interaction, that is referred to as a transaction. Now, the moment the transaction takes place, someone has to keep a record of the transaction. Someone has to write down that such and such transaction has taken place on such and such day. So this responsibility is again entrusted to the accountant. And what the accountant will do is, accountant will record the transaction. And for recording the transaction, he would be using a book of account, which is called as journal. So the moment the transaction takes place, the transaction gets recorded, the transaction would be written down into books of accounts, which are referred to as journals. Now, when we are writing the transactions into journals, there is no bifurcation, there is no segregation. Here, transactions are written down chronologically. Depending on the date and the time with which the transaction is taking place, you will go about recording the transaction. After this, the second step is where you go about segregating your transactions. You go about grouping your transactions. There might be some transactions where there is an outflow of money. There might be some transactions where there's an inflow of money. There might be some transactions where there's a sale that you're carrying out. There might be some transactions where there's a purchase that you're carrying out. Okay, so these two categories of transactions. So these are the different segments. These are the different groups. These are the different categories of transactions which are taking place. Now, where exactly do you go about grouping the transactions? You will go about grouping transactions into books of accounts, which are called as ledgers. Okay, so ledgers are specialized books of accounts where you segregate the transactions and then you would be writing down. So you would pick up the transactions from journals where you have written down them first, and then you will rewrite them into ledgers. So that is what the second step is all about, classifying. The third step is summarizing. What happens in summarizing phase? Summarizing phase, what happens is you want to know what is the collective outcome. What is the net result? You have been doing transactions for so long period of time. Okay, you have been doing for one entire financial year. You want to know, are you making profit? Is your firm running on a loss? You want to know the net outcome. So this net outcome is determined with the help of summarization. Okay? This net outcome is determined with the help of summarization. So what does really happen in summarization phase? In summarization phase, you will go about with the preparation of final accounts. Okay? You will go about with the preparation of final accounts. So when you prepare final accounts, what happens is you're trying to evaluate and see what is the net result. You're trying to see what is the outcome, what is the benefit, what is the end result that you gain. So, okay, so that is summarization phase, and for summarizing you will prepare final accounts. So these are the three steps to accounting process: recording, classifying, summarizing. Now let's visit each of these steps in detail. Let's talk about these steps one by one in detail. The very first step to accounting process is recording. Okay, the very first step to accounting process is the system of recording. Okay, so what happens actually in recording? Okay, what happens in recording phase? In recording phase, what happens is you are writing down the transactions chronologically. You're writing down the transactions chronologically. And when you write down transactions chronologically, we already saw that you would be depending on a book of account, which is called as journal. Okay? So why exactly are you doing this, or what is the benefit behind doing this? So let's look at that in detail. So let me just quickly bring up my presentation over here, and there goes that. So in accounting process, recording is the very first step. Okay, recording is the very first step. So here you would just write down the transaction irrespective of the nature and the type. There might be some transactions where there is inflow, you're generating income. There might be some transactions where there is an expense, where money is going out from your hand. But irrespective of that, it doesn't really matter when you carry out the recording. You are just writing down the transactions chronologically. So for a website like IRCTC, which clocks around 25 lakh transactions in a day, I'm talking about pre-COVID time, when they used to clock around 25 lakh transactions in one single day. So what does the accountant at IRCTC do? They will just write down the transactions chronologically. Depending on the date and the time with which the transaction has taken place, you are merely writing this down. Let's correlate this with the very first objective of accounts that we learned. We learned that the first objective of accounts is to keep a systematic record of transactions. We have to keep a track of the transactions which your business is carrying out. So this is the very first step. So in the very first step, what happens is you're writing down the transactions chronologically. Where are you writing them down? You're writing them down into specialized books of accounts, and these books of accounts are referred to as journals. Okay, these specialized books of accounts, they are referred to as journals. Journals are referred to as primary books of accounts. Okay, journals, they are referred to as primary books of accounts. Why are they called as primary books of accounts? The reason why these are called as primary books of accounts is because it is into this that into these books that you will be writing down transactions for the very first time. Okay, so for the very first time, the transactions will be written down into books of accounts, which are called as journals. Now, this process of writing down these transactions into journal, it is called as journalizing. Okay, the process of writing down the transactions into the journals, this is called as journalizing. So here, what is happening is transactions are taking place. You are writing down the transactions chronologically. You're writing them down into specialized books of accounts called as journals, and journals are referred to as primary books of accounts. And this process of writing down the transactions in that sequence, it is referred to as journalizing. Let's move on to the second step. What is the second step? Second step is classifying. What happens in the second step of accounting process? So here, what happens is that you are grouping the transactions depending on the nature and the type. There might be some, you'll be able to categorize the transactions depending on certain basis. So for example, sale transactions, where you're selling goods to your customers. Purchase transactions, you're procuring some items, you're procuring some raw material, you're interacting with the suppliers, you're interacting with the vendors, you're getting the items from them. That is the second step. Then you have then what happens is you will have to group these transactions depending on the nature and the type. Okay? So depending on what category of transactions these are, depending on what nature of transactions these are, you will have to go about grouping them. So once you have grouped these transactions, then what will happen is you will have to rewrite them. Where are you rewriting them? You're rewriting them into specialized books of accounts. Okay, you're rewriting them into specialized books of accounts. So these books of accounts called as ledgers. So remember the very first place where he had written down the transactions, they were journals. From journals, we have picked them up. We are rewriting them into ledgers. Now, what are ledgers? Ledgers are referred to as secondary books of accounts. Okay, ledgers, they are referred to as secondary books of account. Why are they called as secondary books of accounts? Because the primary book of account is journal. Okay, so the ledgers are secondary because it's the second place where you're writing them. Here, this is the second place where you're writing them. That is the reason why ledgers are called as secondary books of accounts. So in secondary books of accounts, namely the ledgers, what you're doing is you're classifying the transactions based on the nature. Then this process, this procedure of picking up the transactions from journals, writing them into ledgers, that is called as posting. Okay, that is called as posting. So posting refers to the process with which you will go about rewriting the transactions from journals into ledgers. Okay? So the process of rewriting the transactions, picking up the transactions from journals, rewriting them into ledgers, that is referred to as posting. So where do you post the transactions? You're posting transactions into specialized books of accounts, which are called as ledgers. Now let's move on. The final step to accounting process is referred to as summarizing. What happens in summarizing phase? What happens when you summarize your transactions? Please remember, summarizing is the last step. This is the final step. So here we are planning to determine what is the outcome. For example, one full semester you might be studying your subjects. The institution, your parents, they want to know what is the outcome of the results that you have studied. So for that, an examination and evaluation would be carried out. That is referred to as outcome of the transaction. So throughout the year, throughout the financial year, your business is carrying out a number of transactions. Now we want to know what is the end result, what is the net outcome of these transactions that you have carried out. That is referred to as summarization. Now, by summarizing, there are two important parameters that you're interested in estimating. The first is that you want to know the profit position. Second is that you want to know the financial position. I'll repeat that. There are two important aspects that you want to know by preparing the final accounts. First is you want to know profit position. Second is that you want to know the financial position. What do you mean by profit position? Profit position is the comparison between your revenues and expenses. Revenues, you're getting money. Expenses, you're paying money. So the comparison between these two, that gives you an idea of your profit position. So the evaluation of your profit and your loss, that is referred to as profit position. Second is you want to know your financial position. What is meant by financial position? Financial position is an evaluation based on your assets and your liabilities. You're comparing the assets of a firm, you're comparing the liabilities of the firm. You want to know, have you done a good job? That is referred to as financial position. So financial position is the comparison of the assets and the liabilities of your firm. So you are preparing final accounts, you're carrying out summarization in your business to evaluate these two positions of your firm. Let's move on. How do you go about with the estimation of profit position? How do you go about with the estimation of financial position? You do this by preparing what is called as final accounts of a business. So for example, summarizing, we were learning journals. Classifying, we were dealing with ledgers. Summarizing, we will be dealing with final accounts. So by preparing final accounts, what are you exactly doing? You are preparing the trading account, profit and loss account, balance sheet. That is what we will be doing as a result of the summarization phase. So let's just quickly recap on the accounting process. Accounting process starts with your transactions. You record transactions into journals. After that, you classify. Where do you classify? You classify them into ledgers. And then finally, you summarize. You summarize because you want to know the net outcome of your firm. And you summarize your transactions by preparing the final accounts.